All right, folks, welcome back. This is price action model number 9, algorithmic lecture and discussion. This is a one-shot, one-kill model, and it is specifically dealing with stalking 50 to 75 pips per week. And again, there's no necessity for me to go through all of the rules and things that go along with the trading plan, the model. That's already been covered. And I kind of want to give you some ideas on how I personally approach this and how I use it. Preferably, I want to look for the weekly range expansion. I'm going to try to get a feel for that. And if I can, trust the higher time frame bias. But there is many times you're going to find that waiting and seeing what the first day of the week trades like, it kind of either confirms or negates the idea that you had probably over the weekend or the end of the previous week's analysis. And I'm looking for a Monday, Tuesday, or Wednesday, but I'm willing to kind of like give up the Monday, because think about the logic I taught. 70% of the time, Tuesday makes the higher low of the week. So if there's a lot of opportunity or odds that Tuesday creates the higher low of the week, is it really that big of a deal if you don't take a trade on Monday? In my opinion, my view is no. So I'm willing to give up the Monday's trading for that reason. Now, there are times over the past 30 years that I can look back and say, I wish I would have traded on Monday because it created an absolutely stunning high or low of the week. And I left a lot of the range on the table because I didn't participate on Monday. But it doesn't happen so much that I beat myself up about it or am willing to change my ideal scenario, which is wait on Monday, use that for intel, and then trade on Tuesday or Wednesday. But I'm looking for, something to the effect of a optimal trade entry, return back into a fair value gap, something that gives me a very clear run on liquidity, relative equal lows. I mean, it's going to be like a textbook ICT setup. And if I don't have it, then I'm just going to do small little scalps and just get my money that way. So I'm not worried about forcing this model, but I go in with the expectation of looking for it. But if, again, say I'm off and I'm not accurate with my analysis and or I miss a move, then I'll have to use the smaller short-term intraday approaches to get what I need instead of getting one shot, one kill, 50 to 75 pips for that week. All right, I'm going to use the same example because of model number 8. That example is exactly how I would incorporate and utilize one shot, one kill. I go in, I use model number 8 and model number 9 together. So I'll explain as I go, but the levels here, obviously, without having to mention it again, and this is what those two levels are. So when we go into the lower time frame chart, you'll see it. The logic is we consolidated here, took out the buy stops. I don't want to go too much into what I've already discussed in model number 8. But the expectation is the weekly range should expand lower, given the benefit of the doubt. And if you look at the range, this low here, why this low? Why not that low? You could use that low. I like this one because this is where the energetic price run starts for this swing, all the way up to the high here. Okay, you would measure that from low to high to get your range. Equilibrium, okay, and it would cause us to be interested in these relative equal lows. Now, obviously, with the benefit of hindsight, you can see what it is here, but we're going to go into the idea of one shot, one kill in concert with model number 8. All right, and here's the 5-minute chart again. All the business with the S&T divergence really qualifying this as decidedly weak because dollar was able to make a lower low where cable was unwilling to make a higher high. Our fair value gap, optimal trade entry, several layers of sell side been taken, and also with the logic behind that hourly buy side liquidity pool has been taken, and the old imbalance in the form of a SIBI has kept price at bay and couldn't go any higher. So we're likely to see downside expansion on the weekly candle, i.e. possible conditions for one shot, one kill, 50 to 75 pips. So we would go into it with that framework initially. So on a 5-minute chart, all the business that's been done on the model number 8, which is the 6% per month, like a bread and butter type setup. Every single one of my one shot, one kill trades, I'm trying to do this type of scenario. I want to do a separate trade where I'm only trying to get what would be described as model number 8. It's a complete trade altogether by itself, its own individual order. So if I'm going to take a trade using this fair value gap, using this as a stop, I'm going to place 2 limit orders. One is a sell limit order just above this candle's high with a stop loss just above here, 1 or 2 pipettes. And I'm going to be looking for either 5, 10, 15, 20 pips below this low here. This individual trade, which is essentially model number 8, I'm going to take first partial profit at that low. Then I'll take it at 10 pips below that, and then I'll let the remaining portion fill on a limit if I can get it. Once this low is taken out, I'm rolling the stop down just to break even. The one shot, one kill is I'm looking for a scenario that lends a objective that's down here further. But what if I'm wrong? The model number 8 orders take care of that for me. So I don't have to take off anything on my second order, which is a repeat of the same order I used for model number 8's logic. So in other words, if I'm risking 1%, okay, which is what I was teaching in model number 8, if I'm going to risk 2% because I want one shot, one kill, 2% would be 1% applied to the smaller setup that wants to take profit aggressively early. The second one will be a duplicate entry and stop with 1%. So a total risk of what? 2%. 2% of equity. I'm not going to take anything off below this low. I'm going to standard deviation this run from here to here and project that down. And I want to take first partial at 1 standard deviation between this low and this high. Basically, this is a measured move. I would take 1 partial off there. Then I would take another one at 1.5. And then I would look to see if I can get a fill on that old relative equal low on the hourly chart. So one order would be framed like this. This is like model number 8. So I'm doing 2 orders for one shot, one kill. This is how I'm able to really jack up these accounts really quick, because I'm doing multiple orders and I'm trying to get the most juice out of each one. This one here is the best it's going to give me on the smallest portion of the trade. First profit comes off here. Second one is 5, 10 pips below, which would be 125.50. And then we'll see whatever I get, which is the smallest portion always hitting the limit order, because I'm paying that position as it offers opportunity to do so. So it kind of quickly removes risk and bankrolls the equity curve in the account. That's how you see these parabolic runs in my examples, where I'm taking accounts and I'm running them up real quick. No MT4 servers required. Okay, it's math and it's technical analysis and consistency in 3 decades experience. But I'm doing this here. I'm doing one order like this, and then I'm applying a second order that looks very similar to everything else, except for I'm not trying to take a profit until I'm 1 standard deviation of the range from this low up to the optimal trade entry or fair value gap high, projected down. So I'm focusing on these relative equal lows here, because if I do that, I'm using this low to this high. This is equilibrium. So if I'm expecting this to go down and the weekly range to expand, and I'm trying to get as much bang for my buck and not just do a 6% return, which I'm already doing that anyway by taking the trade with 1%, but the second order I'm doing with 1% risk, I'm aiming for these relative equal lows because it's a discount market relative to the low to high, and below equilibrium in a discount market we have this juicy little sell side liquidity pool. So tagging that level there, that's what I'm looking for. I'm looking for a reach into that below this low here or in here. Now, if you have a setup like this is something I do. I haven't taught this anywhere else in the mentorship because we're charter members now. If I have this idea like this, I have a low and a higher low here. What I'll do is I'll take the range difference between that low and that high, right between the middle of that. That's where my order is going to be for a limit. Exactly right there. I'm not fluffing it up for any kind of spread. I'm literally putting it between this low and this high. 50% of that, that's where my limit order would reside. I don't need it to go below that low. Okay, so obviously you can see it does do that, but I've had many times in Forex, especially with FXCM, which is a garbage broker in my opinion, kick dirt in its face every time I get a chance to bring them up. That broker many times would deny me on my limit order because I would have it just below here and they wouldn't let me do it because they're using in-house liquidity pools and they have the benefit of them doing that. So one of the things I did to kind of like beat that game was I would use the midpoint between the two lows, split it in half. That's where my limit order would be. Okay, so put that in your notes. You can use that. I think it'll serve you well. So with that logic, this second order now, again, this is an entirely separate order than that what was used for model number 8. Model number 8 logic is being applied with one trade, one order. Okay, the risk is the same for the second order, but I'm not taking profit off until I get this range here to here duplicated to the downside. So first partial profit will be down here, then to equilibrium. That's what this level is here. And then the old low is sweeping down here. And I'm splitting, which would be essentially probably in this area here, that level would be hit for my hypothetical limit order between the relative equal lows. If it is a really close to one another equal low or relative equal low, then I'll just put it just at or 1 pip at below the relative equal lows. So that way it's really building in the idea that the limit order can fill it. Also, this second order, okay, this is the one I'm going to try to pyramid with if it permits me the opportunity to do so. I did a discussion on the model 6 and 7 universal model, and I talked about how if the range permits me to do 2 stages of accumulation or distribution, if I get that type of scenario in price action, those are the conditions I look for pyramiding. If I don't have it, then obviously I can't do it. So for more logic on that, go back to model number 7. I think I did that in the lecture on the algorithmic theory, talking about where and how I do the pyramiding. For pyramiding, I would use the second order here, which has the one shot, one kill. I would look for new entries anytime it would offer me one, as long as I don't get below the equilibrium. I can take more entries as long as we're above equilibrium. In other words, we're above this level here. Okay, as long as we have not traded down to that level, I don't care if it's 10 pips above it. If it gives me an opportunity to put more on, I will, because it's going to likely sweep through that. That's what my expectation is. So as long as we're above, if I'm shorting, above the equilibrium on the framework that's used for the trade, I will pyramid. So what does that look like? Well, if I did 1% up here, whatever that leverage would be on a $5,000 account, which would be $50 risk, it would yield me, if I did no pyramiding whatsoever and no partials taken off, it would be about almost 14.5% return on the second order. Now, mind you, the other order, the first one, because there's duplicate orders being placed here, it would be around 20% return on just one move with no pyramiding, no partials. But if I take the other one off, as I mentioned, and then the second order is managed where I'm taking first partial after one standard deviation of this range here projected down. First partial, how much would I take off? I'm going to leave that open for your own determination. I don't want to kind of give you a hard and fast rule for how much, because that's always going to be a experience thing. So general rules and principles, how can you look at it? take half off, because that gives you room for 2 partials at 25% of the remaining balance for the next partial or second partial, and then let the third remaining 25% of the trade go to limit order. Okay. If I'm not going to be doing a lot of partials, okay, and I have a lot of conviction that I think we're going to get down below that equilibrium, I won't take any partials at all. I'll be looking to maximize and add to it. So in here, we don't have anything here. We have immediate rebalance here. That would be an area where I would add half of whatever I use for leverage to get into entry here with no partials yet. I would go in and do half of whatever I used for the second order. I would add that as another short, and my stop loss would be just above the gap here, because I wouldn't expect that to be filled. And then as it rode lower, this one here, where it comes back up, we went below equilibrium. I could not add any more. So it would give me just basically one opportunity to pyramid there. And that's really right to the brass tacks, simple, straight to the point, no beating around the bush, get to the point ICT, this is it. But notice how I could not explain this to you if you just started with month 1, or if you just went halfway through the core content. You don't have enough behind you. You might think you do. Some of you have a high opinion of yourselves and you think you're way more intelligent than you really are. But when it comes to these markets, I'm still an infant. I'm learning all the time. Okay, and I've been doing it for 30 years. You are never going to master the market. The market's never going to allow you to master it. The only thing you can do is master yourself and how you're going to engage it. So don't let a false sense of intellect or high opinion of yourself think you can look at this and say, well, you could have saved me a lot of time by just saying it like this. You don't realize, and you're discounting an enormous amount of exposure, time, lectures, examples. Like, you've seen a lot, and you can't discount that. So a perfect example of that is look at the free community. Okay, the free community, I have taught exclusive lessons on bias. And because they have not sat down and watched how I do every single week with you all here, I outline where I think the market's going to go, and we look and see how price delivers relative to the time of day and day of week. And it delivers generally within the scope of what I'm looking for. That's how you learn bias. They want give me one sentence, 2-step rule, and it always repeats the same way, and I don't have to think about it. That's what some of you are going to think about where we are right now as charter members. You're going to think, well, this could have been condensed into a 5-part series and been done with it. No. No, because you don't have any idea what it's like to navigate through all the asset classes and how the quarterly shifts and the seasonal tendencies, sometimes they come in, sometimes they don't. Look at what happened with COVID. I mean, all those things had a major impact. Look at what they've done since the COVID crap. It's all kinds of stuff. So you're getting curveballs thrown at you all the time. And if anybody in here seems to believe that they could have learned all this stuff in just a few short lessons, you are lying to yourself. And there's absolutely no way you could have done that. Okay? Because there's too many variables. The variables are so enormous. And that's why I force the decision on you on how you're going to trade it, because each one of you have these strong opinions about the way you interpret price. They may or not be correct, but you have those individual characteristics that you're bringing to the table as a trader. I'm cognizant of that. So I give room for that. Like anybody that would be a reasonable educator, I give you the freedom and flexibility to choose how it is that you're going to trade. But I give you rules that are hard and fast when and where applicable. And for the answer that I get all the time, how am I running up these accounts, and how am I doing this, and how am I doing that? And when I tell you I'm using mentorship, this is what I'm doing. Okay? Only when I'm buying and selling up and down, up and down, up and down, that's an enigma. And I'm not going to teach that, and you all know that. But you don't need that. You don't need that at all. My son's not even trading with Enigma. And he's doing, in my opinion, doing very, very well for his first month. So let that be a encouragement to you. So hopefully you found this one insightful. Until next time, be safe.